Welcome to this explainer. I'm so thrilled you're here. Look, today we're taking a deep dive into a topic that, honestly, a lot of people mistakenly think is just about ticking boxes and filing paperwork. But the real truth, audit planning is essentially a high-stakes detective's blueprint. We're going to deconstruct the exact methodology that auditors use to systematically hunt down financial misstatements. If you love clear, structured systems half as much as I do, you're absolutely going to find this fascinating. Let's just get right into it. So imagine walking into a massive multinational corporation. We're talking millions of transactions happening every single day. Before an auditor even looks at a single receipt, how on earth do they know where to begin? I mean, you can't possibly look at everything, right? It would literally take a lifetime. The secret to all of this lies in a highly calculated, meticulously structured planning phase. To break this down, here's our roadmap for today. We'll kick things off with the audit planning mission, then we'll move into mapping the accounting system, assessing material risks, linking risks to controls, and finally, bringing it all together in the master audit plan. Okay, let's dive right into our first stop, the audit planning mission, which is really the foundation of a risk-based audit approach. The absolute fundamental thing you've got to grasp here is that modern auditing is a risk-based strategy. It's not just some blind compliance exercise where you check every single thing equally. Under International Standard on Auditing, or ISA 300, an audit always kicks off with pre-engagement activities. You know, things like ensuring ethical independence and locking in the terms of the engagement. But the second that's signed off, we move directly into the planning phase. And why is that? Well, because auditing requires really close inspection, very much like an investigator using a magnifying glass. Good planning lets the auditor set the overall scope, the timing, and the specific direction of the audit. Basically, it ensures your team's extremely valuable time and resources are deployed exactly where they're needed most and nowhere else. Moving right along to part 2, mapping the accounting system, or as I like to call it, charting the terrain of the entity. Think about it like this. Before a detective starts looking for clues or anomalies in a building, they first need the blueprints, right? They have to chart the terrain. Well, for an auditor, this terrain is the entity's entire accounting system. To really understand how major transactions are initiated, authorized, and eventually recorded, the auditor has to formally document that system. According to the standards, there are 3 primary, widely accepted ways to actually do this. First up, you've got narrative descriptions. These are basically just written summaries of the processes. Second, internal control checklists, which act as structured questionnaires. And third, system flowcharts. Now, imagine you're trying to map your way out of a complex maze. While those narrative descriptions provide really excellent written details, they can honestly become incredibly cumbersome to read and a total pain to update year after year. Flowcharts, on the flip side, offer this standardized visual diagram. They track the exact flow of documents right through the system. When they're properly prepared, flowcharts make the original source and the ultimate destination of every single document crystal clear. It is just a much more efficient way to visualize the terrain. All right. Now for part 3, assessing material risks. This is where we start spotting the real dangers hidden in the numbers. So now that we have our map perfectly laid out, we need to locate the hazards. And to do this, we really need to define our absolute biggest enemy in auditing, the risk of material misstatement. This is the risk that the financial statements contain significant inaccuracies or omissions before the audit even gets underway. It's literally the ultimate problem that the entire audit plan is trying to solve. Remember, we are actively hunting for errors big enough to actually change the economic decisions of someone relying on those financials. Now, what's really interesting about this is exactly how we break that risk down. According to ISA 200, one massive component here is inherent risk. And that's just the natural, built-in vulnerability of a specific transaction or account balance way before we even consider any internal controls the company might have put in place. Think about it this way. A pile of highly desirable, easily movable physical cash has a massively high inherent risk of being stolen, compared to, say, a 5-ton piece of factory machinery. The risk is just baked right into the nature of the asset itself. Which naturally leads us to the single most important recurring investigative question that every single auditor must ask themselves at absolutely every stage of the transaction process. And that question is simply, what could go wrong? We take that what could go wrong question and we apply it directly to what we call management assertions. Whenever management hands over a set of financial statements, they're essentially making these invisible claims. Take rights and obligations, for example. Sure, that factory or fancy computer system is sitting there on the balance sheet. But do we actually own it? What could go wrong there? Well, maybe the asset was actually sold last month, but mistakenly left on the books. Or let's look at accuracy and valuation.
Is the inventory sitting back in the warehouse damaged, slow-moving, or just totally obsolete? Because if it is, its value is significantly overstated. Constantly asking what could go wrong forces the auditor to pinpoint those exact vulnerabilities.
That brings us to Section 4, linking risks to controls. This is where we step back and evaluate the organization's defenses. Because organizations aren't just sitting there totally defenseless, right? Management usually responds to these inherent dangers by implementing internal controls, rules, checks, and balances, specifically designed to catch or prevent these exact errors. And the auditor's job is to evaluate those defenses. This brilliantly illustrates exactly how this linkage works in the real world. We're zooming in on a routine, everyday process, like making a vendor payment, and directly linking it to a defined risk and a specific financial statement assertion.
So the crucial point to take away here is just how mechanical and completely logical this mapping process is. Let's walk through this step by step. The process: processing a final payment for some computer equipment. The risk: an inflated rate in the final invoice that ends up being way higher than the originally quoted rate. Now, what could go wrong? Well, an overstatement of company expenditure, which completely violates the accuracy assertion. So what's the mitigating control activity? Someone independent must physically check that final invoice against the original purchase order before authorizing any cash to go out the door. The auditor spots the exact vulnerability and maps it directly to the exact control meant to stop it. It is just beautiful, highly structured logic.
All right, on to our final section, Part 5, the Master Audit Plan, where we bring this entire strategy together.
This is the exact moment where charting the terrain, finding the risks, and evaluating those controls all finally culminate into one comprehensive strategy. Let's trace how this actually builds. You start right at the top with the audit assertions, what management is claiming is true. Next, you identify the specific risks to those assertions. Then, you look at the internal control activities in place. And based on all of that combined information, the auditor designs very specific procedures. If the controls look strong, we test the controls. But if the risk is super high or the controls are totally weak, we have to design heavy, substantive tests of the actual transaction details. The level of risk drives the exact design of the work. And of course, all of this gets formally documented. The Master Audit Plan is the official blueprint. It contains everything: the engagement objectives, a full summary of the risk assessment, the materiality thresholds, which really just means exactly how big an error has to be before we actually care about it, the specific audit approach, and finally, the timing and phasing of the team's work. Having this plan ensures that every single hour billed by the audit team is hyper-focused purely on the areas of greatest risk. But hey, you have to remember that an investigation is fundamentally a team effort. You can't just write a completely brilliant plan and then shove it in a desk drawer. The planning phase officially concludes with a mandatory audit team planning meeting. This is that crucial moment where the senior partners share the blueprint with the boots on the ground. They discuss the specific potential for material misstatements due to fraud or error, ensuring that absolutely everyone on the team is out there looking for the exact right clues.
And that wraps up our breakdown. We've mapped the system, spotted the risks, and built the ultimate blueprint. But I want to leave you with this final, somewhat provocative thought. A plan, no matter how flawlessly structured it is in theory, is really only as good as its execution out in the field. The systems and the flowcharts, sure, they're flawless on paper, but it ultimately relies entirely on the professional skepticism of the human beings doing the actual work to protect the stakeholders. So, is your team ready to execute? Thank you so much for joining me for this explainer. I really hope this structured look at audit planning has brought some serious clarity to your learning. Catch you next time.